When you think of the steel industry, what images come to mind? Perhaps something monolithic, heavy, maybe even a bit, well, traditional?
Beautiful old smokestacks, maybe.
Exactly. Or could it be a sector defined by agility, deep innovation, and surprising commitments to sustainability? Today, we're diving into a company that might just reshape your entire perception. Our deep dive into the source material today focuses on Steel Dynamics Inc., known as STLD. This isn't your average commodity story, not at all.
No, it really isn't. It's about a very unique business model, the strategic application of, cutting-edge technology and some really ambitious growth plans that are truly setting this North American steel producer and metals recycler apart.
Right. So our mission for you today is to cut through what could be a pretty dense financial and industry analysis. We're going to extract the most important nuggets of knowledge and insight, offering you, hopefully, a direct shortcut to being truly well-informed about STLD, about its remarkable strengths and its pivotal role in shaping the future of essential industries.
Get ready to connect some dots, maybe in ways you haven't before.
So what exactly will we be uncovering in this deep dive? We're going to unpack STLD's distinctive circular business model.
Which is fascinating in itself.
Yeah. Explore its powerful competitive advantages, examine the unique trends reshaping the U.S. steel market specifically.
A really important distinction there.
It is, and then look at how the company is driving some aggressive growth. We'll also dig into its financial health. And finally, pinpoint the key risks and opportunities that truly define its ongoing story. Sound good?
Let's jump in.
All right, let's unpack this foundational idea. At its core, Steel Dynamics is described as a formidable force, not only one of the largest domestic steel producers, but also, perhaps unexpectedly, the largest metals recycler in North America.
That recycling piece often surprises people.
It does. But what really separates them right from the start, as our research highlights, is their exclusive reliance on electric arc furnace, or EAF, technology. And it's within a vertically integrated circular business model.
Right. That's a lot of specialized terms, but they're absolutely critical to understanding their success.
So maybe break that down. What's fundamentally different about their approach?
Well, it starts with that foundational choice, EAF. And this circular model they've built, it isn't just some modern buzzword or greenwashing. It's the very engine, through which they consistently achieve what the industry considers best-in-class operational efficiencies, superior profitability, and really high returns on capital. Think of it as a self-reinforcing system, almost like a highly efficient closed loop. It drives their competitive edge and allows them to perform at a level many of their peers, frankly, can only aspire to.
Okay, so a fundamentally different way of operating. Now, our sources present a clear investment thesis for STLD, offering both a bullish, positive view and a bearish, more cautious one. It's always important to look at both sides of that coin, right, to get the complete picture.
It's absolutely essential.
Let's start with the factors that make the bullish case so compelling. What are the main pillars here?
Okay, the first pillar supporting the bullish view is their superior and resilient business model. This seems to refer directly to that flexible, low-cost EAF steelmaking we mentioned.
Which is inherently crucial in an industry known for its ups and downs, right?
Exactly. They've also built incredible vertical integration through their OmniSource scrap metal recycling subsidiary. That means they effectively control a significant portion of their primary raw material supply.
A huge advantage.
Yeah. And then there's a strategic downstream fabrication business that actually consumes some of their own steel products. So this combination isn't just a collection of, disparate assets.
No, it's a system.
It's a powerful, self-reinforcing system that consistently generates industry-leading margins and robust cash flow across the entire economic cycle. It builds a durable competitive advantage that, frankly, sounds very difficult for competitors to replicate.
Very difficult. It's deeply integrated. Okay, moving to the second bullish point, a clear and ambitious growth trajectory. This includes the ongoing ramp-up of their technologically advanced Sinton, Texas flat roll mill, which is a significant expansion in itself.
A major investment.
But what truly stands out as potentially transformational is their strategic diversification into the North American aluminum market.
That's the big one everyone's watching.
It seems like it. These aren't minor factory upgrades. They are substantial, multi-billion-dollar investments targeting high-growth, high-value end markets. The company is leveraging its core competencies in recycling-based metal production, essentially taking its proven EAF playbook from steel.
And applying it to a new adjacent industry.
Exactly. The potential to significantly expand their earnings power and market scope is absolutely massive if they succeed in these ventures.
Huge potential upside there.
And finally, rounding out the bullish case, is their disciplined and effective capital allocation. Management seems to have a proven track record, which is always a reassuring sign for investors, right?
Always look at the track record, yes.
They've demonstrated a clear ability to balance aggressive, high-return growth investments like those new mills with substantial and growing returns of capital back to shareholders.
And they do that through both dividends and significant share repurchases.
Right, which boosts value for existing shareholders by reducing the total share count.
Yeah.
It really shows a thoughtful, strategic approach to managing their abundant cash flow.
It's a very balanced approach. Okay, that's a robust, bullish case. But it's equally important, as you said, to consider the counterarguments and the inherent challenges that come with operating in this industry.
Definitely. What are the main bearish points?
Well, the first major one is the inherent industry cyclicality. Let's face it, the steel industry is notoriously volatile. Boom and bust cycles are just part of the game. This means STLD's earnings, its cash flows, and ultimately its stock valuation are always going to be subject to the wider swings of the macroeconomy. A significant downturn in key end markets like construction or automotive,
Which are huge for steel.
exactly. A downturn there would directly and inevitably impact their performance. You simply can't escape that fundamental economic reality, no matter how good your model is.
Makes sense. What else?
Then there's execution risk on large-scale capital projects. This is a particularly important point for STLD right now, given what we just discussed.
That aluminum mill, especially.
Precisely. That multi-billion-dollar entry into the aluminum market, it's not a minor undertaking. It's a venture into a new and highly competitive industry where STLD's operational playbook, while successful in steel, has yet to be fully proven for aluminum.
Right. It's a different metal, different market dynamic.
Exactly. And while they certainly have a strong track record in building steel mills, the sheer scale and the novelty of this aluminum endeavor mean that delays, cost overruns, or failure to meet performance targets are very real concerns. These aren't just small factory expansions, they are massive, greenfield, state-of-the-art facilities that introduce their own set of unique complexities and risks.
A big bet, then.
A very big strategic bet. Finally, the bearish perspective highlights import competition and domestic overcapacity. The U.S. domestic steel market faces persistent threats from lower-priced imports, often originating from countries with their own excess capacity, particularly in Asia.
Yeah, that's always been an issue for U.S. steel.
Always. And there's also the potential for domestic overcapacity if too many new mills come online, maybe from competitors or even STLD itself, without a corresponding increase in actual demand. Both of these factors, imports and overcapacity, could put downward pressure on steel prices and compress margins over the long term, regardless of how efficient STLD itself is. Market forces still apply.
So with these significant risks always present, how does STLD plan to navigate them while still pursuing such ambitious growth? It sounds like a tightrope walk.
That's the critical question the analysis tackles. It concludes that while STLD's operational excellence and strategic vision are clearly distinguishing factors, real advantages, their future performance hinges critically on management's ability to execute against this backdrop of persistent cyclicality and intense competition.
Execution is key.
It's everything right now. It's one thing to build new, advanced facilities. It's another thing entirely to consistently make them profitable, hit those utilization targets, and integrate them smoothly, especially in a challenging global market. This execution capability will be the key differentiator moving forward.
Okay, let's delve deeper into that core setup then. You mentioned the circular manufacturing model as central to STLD's success. Can you maybe paint a clearer picture of what that looks like in practice? How do these pieces actually fit together to create that incredibly efficient system you described?
Yeah, absolutely. It's truly a deliberately crafted and highly synergistic system. It's engineered, really, for maximum efficiency and resilience across their entire value chain. So essentially, they begin by collecting and processing scrap metal. That's where their OmniSource recycling subsidiary comes in. Big time.
Okay, so step one, get the scrap.
Right. This scrap is then melted down to produce new, high-quality steel in their EAF mills. That newly produced steel is then sold to diverse end markets, which is standard. But crucially, a significant portion of it goes directly to their own downstream steel fabrication business.
Ah, so they're their own customer, in part.
Exactly. This creates a closed-loop system that optimizes costs by securing their primary raw material scrap, ensures a reliable supply, and enhances profitability throughout the economic cycle. It means they're not just buying scrap and selling steel on the open market like some others. They're actively managing the entire life cycle of the material, from end-of-life products like old cars or washing machines right back into new steel products.
That makes perfect sense. So we're talking about more than just manufacturing. It's like a holistic ecosystem they've built.
That's a great way to put it, an ecosystem.
Let's break down the three primary operating segments that underpin this model, plus that intriguing fourth emerging segment we touched upon, the aluminum one. First up, we have steel operations. This is absolutely the core of the enterprise, right? Accounting for about 72% of their total revenue.
The lion's share. Yeah.
This segment includes 6 advanced electric arc furnace mini mills and numerous value-added coating facilities. Collectively, this gives them about 16 million tons of shipping capability annually. Huge capacity.
Massive.
And their product portfolio is highly diversified, which is important for market stability, I assume. They produce flat roll products like hot roll, cold roll, coated sheet steel, then long products like structural steel beams, shapes, and rail. And they also make engineered special bar quality, or SBQ, steel.
That's the high-end stuff used in demanding applications like automotive drivetrains.
Right. So this segment truly is the primary profit and cash flow engine for the entire corporation.
Absolutely. It drives the train.
Okay, next, there are the metals recycling operations, largely operating under the OmniSource name.
Right.
You mentioned this is critical for their vertical integration.
Hugely critical. OmniSource is one of North America's largest metals recyclers. They're actively processing both ferrous, that means iron and steel, and non-ferrous scrap from really diverse sources. Think manufacturing offcuts, demolition sites, end-of-life products like automobiles and old appliances. They gather it all.
Okay.
Now, this isn't just a standalone profit center, though it certainly is profitable in its own right. It's crucially a strategic supplier to their own steel operations. It provides a secure, reliable, and significantly cost-advantaged source of high-quality scrap.
Their main raw material.
Exactly. Their primary raw material for EAF steelmaking. To put a number on it, in 2023, OmniSource internally supplied nearly 3.6 million tons of ferrous material to STLD's own mills. Yeah. This internal sourcing capability is a key differentiator and a very significant cost and supply chain advantage for them. It insulates them, partially at least, from the often wild swings in the external scrap market. That's a huge benefit.
Definitely.
Yeah.
Okay, then we have steel fabrication operations. What does this segment do?
This segment primarily produces things like structural steel joists and deck building systems, largely for the non-residential construction market. Think of like warehouses, office buildings, things like that.
Okay.
And it serves as a key downstream consumer of STLD's own steel products. This provides a strategic pull-through of volume, meaning it creates a guaranteed customer for their steel mills. This helps maintain high plant utilization rates at those mills, even when external market demand might be a bit weaker.
So it helps keep the mills running efficiently.
Exactly. What's more, this fabrication business often acts as a natural hedge against steel price volatility. Its margins can actually expand when steel prices, which are its primary input cost, are falling. So when the steel mills might be feeling pressure, the fabrication side can actually do better.
Interesting.
Yeah, it provides a valuable counter-cyclical earnings stream. It's almost like a built-in shock absorber for the overall business performance.
A clever setup. And finally, the emerging segment, aluminum operations. This is their major strategic diversification we discussed.
The big new frontier for them, yeah.
STLD is constructing a state-of-the-art 650,000-ton recycled aluminum flat-rolled mill in Columbus, Mississippi. Now, this isn't a random jump into a new market, is it?
No, not at all. It directly leverages their core competencies, their deep expertise in metals recycling through OmniSource, and their proven ability to build and run efficient recycling-based metal production facilities. They're applying the same principles.
Okay.
The first commercial coils from this new facility were actually shipped in June 2025, which marked a significant operational milestone. It's the birth of a brand new growth platform for the company.
Exciting times for them, then. So these segments clearly feed each other, creating that circular flow you've described so well. But the analysis really emphasizes the EAF technology itself as fundamental to all of this.
Hmm.
For a learner, maybe someone less familiar with steelmaking, what's the big takeaway about why EAF is such a game changer compared to those traditional methods, those old blast furnaces most people picture?
That's a critical question because the shift to EAF isn't just, an incremental improvement. It's truly transformative for the industry, and STLD was built on this from the start.
Yeah, okay.
The EAF method melts recycled scrap using powerful electric arcs. Imagine giant electrodes creating intense heat. This is a stark contrast to the traditional basic oxygen furnace, or BOF, process. The BOF method refines molten iron, which is first made from raw materials like iron ore and coking coal in massive, continuously operating blast furnaces.
Okay, so EAF uses scrap, BOF uses raw ore and coal.
Primarily, yes. And the advantages of EAF are profound and multidimensional. Firstly, there's a superior cost structure. EAF mills, often called mini mills, have significantly lower capital costs to build. We're talking an estimated $140 to $200 per ton of annual installed capacity
Wow.
versus upwards of $1,000 per ton for a traditional integrated mill with blast furnaces and coke ovens. That's a monumental difference in upfront investment.
Huge difference.
And this lower fixed cost base is a crucial advantage in an inherently cyclical industry. STLD's operational excellence translates this technological advantage into tangible results. Their average production cost is approximately $620 per ton, which is significantly below the estimated industry average of $780 per ton.
So that's that $160 per ton cost advantage you mentioned earlier.
That's it. That cushion allows them to remain profitable and continue investing even when steel prices drop and others are struggling to even break even. It provides incredible resilience.
Okay. Cost is one big advantage. What else?
Secondly, operational flexibility is a huge benefit. Unlike blast furnaces that essentially must operate continuously for months or years at a time.
Very hard to turn off and on.
Exactly. EAFs can be started and stopped relatively quickly and efficiently, even daily if needed. This allows production levels to be rapidly adjusted to match fluctuating market demand, minimizing waste, and optimizing resource use. That responsiveness provides a critical competitive edge over the more rigid, less adaptable BOF operations. They can react swiftly to market signals, ramping up or down, rather than being forced to run at full tilt regardless of demand or pricing.
More nimble.
Much more nimble. And here's what's truly compelling for the modern economy and increasingly important: environmental leadership. The EAF process is inherently more environmentally friendly.
Because it uses scrap.
Primarily, yes. By using recycled scrap as its main input, it bypasses the incredibly carbon-intensive processes of mining iron ore and producing coke from coal, which are essential for blast furnaces. As a result, STLD steel mills produce somewhere between 56% to 63% lower greenhouse gas, or GHG, emissions.
That's a big reduction.
Huge. And they consume 76% to 79% less energy compared to the average traditional blast furnace operation. With the increasing focus from customers, investors, and regulators on decarbonization and supply chain sustainability, this low carbon footprint is rapidly transitioning from just a nice-to-have reputational benefit
To a real commercial advantage.
Exactly. Companies are actively seeking lower carbon options for their products, especially in sectors like automotive and construction. STLD is uniquely positioned to meet that growing demand. It's becoming a key selling point.
So, given these advantages, cost, flexibility, environment, where does STLD strategically locate these cutting-edge operations? What does their physical footprint look like, and why is that important? Where are these mills?
STLD has a truly strategic geographic footprint that spans the United States and also includes facilities in Mexico. These locations aren't random. They're meticulously chosen for their proximity to key factors, things like scrap sources where the raw material is,
That makes sense.
key customer concentrations, reducing shipping distances, and efficient logistics networks like rail lines or ports. This helps minimize transportation costs, which are significant in steel, and improve delivery times to their customer base.
Okay.
Within the U.S. market, STLD has carved out a significant position. It's estimated to hold about a 12.2% market share in the U.S. iron and steel manufacturing industry, and it ranks as the fourth largest North American steel producer by revenue.
So a major player.
A major player. And that vertical integration we keep talking about with OmniSource isn't just about cost saving, though. That's huge. It's a deep strategic advantage, almost like a protective moat around their operations.
A moat. I like that analogy.
Yeah, it provides a resilient internal supply chain, insulating them from some of the volatility in scrap prices and availability. It also ensures they get the quality of scrap they need. This directly contributes to STLD's consistently higher profitability through the entire steel cycle compared to many competitors who are fully exposed to the volatile spot market for scrap. This control over their primary raw material input is a real game changer for their stability and profitability profile.
Okay, so the company itself sounds strong, adaptable, and definitely forward-thinking. But steel is a global industry, right? And global markets can be incredibly tough, often facing oversupply issues.
Yeah.
How does the U.S. market fit into that bigger picture? Our analysis points to something interesting, a unique and potentially more bullish outlook for the domestic market, almost as if it's charting its own distinct course compared to the rest of the world. What's driving that unexpected momentum here?
That's a crucial insight from our sources, and it's really important context for understanding STLD. While the global steel industry faces persistent challenges largely characterized by the risk of excess capacity, particularly coming out of Asia, and often sluggish demand growth in many developed economies, the U.S. market presents a distinctly different story right now.
Different how?
Well, for example, the OECD, which is a major global economic forum, projects a pretty modest 0.7% annual growth rate through 2030 for global steel demand. That's quite slow.
Barely growing.
Barely. However, market forecasts specifically for the U.S. steel market project a compound annual growth rate, or CAGR, of somewhere between 2.2% to 2.4% through 2030. That's potentially reaching a total market value of over $110 billion.
So significantly faster growth projected for the U.S. than globally.
Significantly faster. And that divergence isn't random. It's propelled by a unique confluence of powerful domestic drivers, creating a potentially healthier environment for producers focused here.
Okay, so what are these powerful, almost self-reinforcing drivers that are creating such robust steel consumption, specifically within the United States? What's fueling this difference?
There are several overlapping trends that are creating this unique demand profile. First and foremost, you have infrastructure and construction. Construction accounts for over half, more than 50% of all domestic steel demand, making it the primary steel consuming sector by far.
Right.
And the Bipartisan Infrastructure Investment and Jobs Act, the IIJA, is a landmark catalyst here. It's allocating billions upon billions of dollars specifically to steel-intensive projects. We're talking about the repair and new construction of roads, bridges, public transit systems, water infrastructure, the grid, all things that use a lot of steel.
A generational investment, really.
Absolutely. This legislation is expected to provide a significant and sustained demand tailwind, especially for long products like structural beams and rebar, but also for flat-rolled steel used in fabricated components. And importantly, this isn't just a one-year bump. This is a multi-year program designed to unfold over much of the next decade. It provides a strong base of demand for the domestic industry.
Okay, infrastructure is huge. What else?
Secondly, we're seeing a powerful trend of manufacturing reshoring and onshoring. There's a real secular shift underway in U.S. manufacturing. It's driven by a combination of factors: geopolitical tensions making global supply chains seem riskier, lessons learned from the massive supply chain disruptions during the pandemic, and significant federal incentives designed to bring manufacturing back. Programs like the CHIPS and Science Act focused on domestic semiconductor manufacturing.
Right, building those fabs.
Exactly. And the Inflation Reduction Act, or IRA, which heavily promotes domestic clean energy production, think batteries, solar panels, wind turbines, all made here. This reshoring boom is spurring a historic level of construction for new manufacturing facilities across the country.
We're seeing announcements all the time.
All the time. And this is creating a powerful long-term tailwind for domestic steel demand. These programs are collectively expected to generate something like 39.7 million tons of new steel demand by 2030.
Wow, 39.7 million tons. That's enormous.
It's massive. To put that into perspective, that's like building enough steel infrastructure for several entirely new cities or adding the capacity of dozens of new large-scale factories purely driven by these domestic policy initiatives.
Okay, so infrastructure reshoring. What's next?
Then you have to consider the automotive sector evolution. This is another critical end market, typically representing 20-25% of overall steel demand. And it's a primary consumer of those high value-added products like galvanized and cold-rolled sheet steel.
Right.
The ongoing transition to electric vehicles, or EVs, is fundamentally reshaping steel demand within this sector. Now, you might think EVs use less steel, but they're actually inherently heavier due to their large battery packs.
Ah, interesting.
Yeah, which means automakers are increasingly relying on advanced high-strength steels, or AHSS, to reduce the vehicle body weight, what they call lightweighting. This is crucial for improving driving range and efficiency, but they have to do it without compromising stringent safety standards.
So stronger but lighter steel is needed.
Exactly. And this trend is driving demand for more sophisticated, higher-margin steel products that modern EAF mini-mills, like STLDs, are often better equipped to produce compared to older mills.
Okay, and the last driver.
And finally, the energy transition itself. The global push toward decarbonization is fueling substantial investment in renewable energy infrastructure. Think about the construction of massive wind turbines. Those towers and foundations require immense amounts of steel.
Huge amounts.
Or the fabrication of solar panel mounting structures for large solar farms. This is creating a new and rapidly growing source of steel demand that simply didn't exist at this scale a decade ago. It's a burgeoning market for steel that ties directly into broader sustainability goals.
Okay, so a lot of positive demand drivers here in the U.S. But steel prices are notoriously volatile, right?
Right.
That makes it a challenging environment for producers. How does a company like STLD navigate that constant fluctuation? It feels like trying to sail in a perpetual storm.
You're absolutely right. Hot-rolled coil, or HRC, prices serve as the industry's primary benchmark, and they do fluctuate wildly based on supply, demand, raw material costs, sentiment, you name it. We've seen significant price swings just recently.
Yeah, it seems like they're always moving.
They are. After a period of decline in late 2024, major producers attempted to implement price increases early in 2025, but those were met with some resistance from cautious buyers. Then, in mid-2025, key producers like Nucor and Cleveland-Cliffs actually adjusted their spot HRC prices downward again to reflect the prevailing market conditions. Futures contracts, which give a glimpse ahead, recently suggested a price around $872 per ton. So definitely volatile. However, and this is really key for EAF producers like STLD, the absolute price of steel is actually less important to their profitability than the metal spread.
The metal spread, explain that.
That's the margin, the difference between the realized selling price they get for their finished steel and the cost they pay for their primary input, which is ferrous scrap.
Yeah.
That spread is the critical determinant of profitability for them.
Got it. Price out minus scrap cost in.
Exactly. And in its second quarter 2025 results, STLD actually demonstrated its ability to manage this dynamic effectively. They reported an expansion in their metal spread. Their selling prices increased more than their scrap costs did during that period, which directly boosted their operating income.
Ah, so even if overall prices are choppy, they can still improve profitability if their spread widens.
Precisely. It shows their operational agility in maintaining or even growing profitability by managing their costs and product mix, even in a volatile pricing environment. They're focused on controlling that spread, controlling their own inputs and processes, rather than solely riding the unpredictable price wave.
Makes sense. Now, what about international competition and trade policies? Does the U.S. market operate in some kind of protected bubble, or is it still vulnerable to global forces? Imports are always a concern, aren't they?
The U.S. market definitely does not operate in a vacuum. It's heavily influenced by global trade dynamics. Imports remain a constant challenge for domestic producers. In January 2025, for instance, finished steel imports were estimated to have captured a full 25% share of the U.S. market. 1 quarter.
Well, that's significant.
It is. And the OECD has highlighted that a surge in low-price exports from countries like China has disrupted international markets and increased trade tensions globally. Now, the imposition and potential reintroduction of tariffs on imported steel, like Section 232 tariffs, are intended to level the playing field and make domestic producers more competitive.
Do they work?
Well, the impact of these policies is complex. While they can certainly support domestic pricing and production levels for companies like STLD, they can also create uncertainty for the whole economy. And they've been cited by some market participants, particularly steel consumers, as a barrier to economic activity because they can disrupt supply chains and raise input costs. It's truly a double-edged sword with winners and losers.
Okay, so considering all of that, the unique U.S. demand drivers, the price volatility managed by the spread, the import situation, it really does sound like the U.S. market might be on a distinctly different path compared to the rest of the world right now. What's the core implication of that for a company like Steel Dynamics?
This is really a critical distinction, maybe the central point about the market context. A deep evaluation of these factors strongly suggests that the U.S. steel market may actually be decoupling, at least to some extent, from the more bearish global and broader OECD outlooks.
Decoupling. Interesting.
Yeah. While the OECD's forecast for the entire bloc is shaped heavily by things like a contracting Chinese property market and general economic sluggishness in Europe, leading to that projection of basically flat demand, the U.S. is experiencing a different reality.
Driven by those policies we discussed.
Exactly. The powerful multi-year legislative tailwinds from the Infrastructure Act, the Inflation Reduction Act, and the Cheap Cheapies Act are creating a unique, domestically focused demand cycle that could persist for several years. And crucially, these programs often include Buy American provisions.
Oh, that's key.
Very key. These provisions further insulate domestic producers from some global economic trends and import pressures, steering that government-funded demand towards companies making steel here. This creates a potential divergence where U.S. producers could experience a period of sustained, elevated demand while the rest of the world might be grappling with overcapacity.
So what does that mean for an investor looking at STLD?
It means an investment in a U.S.-focused producer like STLD becomes less a broad wager on the global economy and more a targeted investment in the successful and timely execution of these specific domestic infrastructure and manufacturing onshoring projects. That's a significant shift in how we might view the risks and opportunities in this sector. It's more about U.S. execution than global cycles right now.
Okay, so with this unique U.S. market context, who are STLD's major rivals in this evolving landscape, and how do they truly measure up against them? Who are they fighting against day to day?
Right. The U.S. steel industry, while it seems vast, is actually dominated by a handful of major players who compete fiercely. They compete on technology, on cost structure, product mix, customer service, overall strategy, everything.
Who are the big names?
In terms of domestic sales revenue, the competitive hierarchy is generally led by Nucor.
Okay, the biggest.
Yeah. Followed by Cleveland-Cliffs, then Steel Dynamics, and finally U.S. Steel, which is currently in the process of being acquired. But the most significant differentiator among them by far is their underlying production technology. This creates what our sources call a great technological divide in the industry.
The great technological divide. Tell us more about that. What are the key differences between these camps?
Absolutely. We essentially have two distinct camps based on how they make steel. On one side, you have the EAF producers, or mini mills. This is where Steel Dynamics and Nucor really shine. They are the archetypes of this modern approach.
Okay.
Their business models, as we've discussed, are characterized by significantly lower capital and operating costs, much greater operational flexibility. Remember that ability to start and stop production quickly.
Right, the nimbleness.
Exactly. They also tend to have a largely non-unionized workforce, which often contributes to lower labor costs and more flexible work rules. And critically, they have a significantly lower environmental impact due to the EAF process. They truly represent the modern face of the American steel industry, focused on agility, efficiency, and increasingly sustainability.
Okay, that's the EAF camp. What's the other side?
On the other side are the integrated producers, relying on blast furnaces. This camp includes companies like Cleveland-Cliffs and U.S. Steel. They represent the legacy of the industry, the traditional way steel was made for over a century. Their operations are typically vertically integrated upstream into iron ore mining. They own the mines that feed their large, incredibly capital-intensive blast furnaces, which melt the iron ore, and coke ovens, which make the fuel. Now, these companies are certainly capable of producing very high-quality steels.
They make good steel.
Absolutely. But they are historically burdened by higher fixed costs. Those massive furnaces have to run constantly. They have less operational flexibility because of that continuous operation requirement. And they often carry significant legacy costs related to pensions from past generations of workers and complex, often more rigid labor agreements. It's a much heavier, less adaptable operational model compared to the mini mills.
Okay, two very different models. So how does STLD stack up within this competitive landscape, particularly against its main EAS peer, Nucor, and then against those integrated players like Cliffs and U.S. Steel? What are the key distinctions when you compare them head to head?
Right. Let's do a quick comparison across a few key dimensions. First, when we look at their operational model, while both STLD and Nucor are champions of the EAF model, STLD's structure is arguably uniquely circular, as we've detailed.
That deep integration.
Exactly. Its deep vertical integration into both upstream scrap collection via OmniSource and downstream consumption via its fabrication segment creates this powerful internal synergy. It gives them both a secure raw material supply and a baseload of demand for their mills, which is crucial for maintaining those high utilization rates we talked about.
Right.
This is distinctly different from, say, Cleveland-Cliffs integration, which is upstream into iron ore. That faces different commodity cycles, different cost structures, different logistics. STLD's circular scrap-based model is quite unique in its completeness.
Okay. What about size and market position?
Good question. In terms of raw crude steel production volume, Nucor is generally the largest domestic producer. They just make more tons overall.
Oh.
However, production volume alone isn't the whole story. STLD consistently achieves higher plant utilization rates than the industry average. For example, our sources say 91% of its estimated capability in 2023, and that excludes the new Sinton mill, which was still ramping up compared to a domestic industry average of just 76%.
91% versus 76%. That's a big difference.
It's a huge difference. High utilization means their assets are working harder, sweating more, producing more efficiently, and ultimately generating greater returns from their invested capital. It's a key indicator of operational efficiency and strong market demand for their products.
Okay. And finally, what about their overall strategic direction? How are they approaching growth differently?
Here, the paths have diverged quite significantly in recent years. STLD has remained steadfastly focused on high-return organic growth projects, building things from scratch, like the Sinton mill and the new aluminum mill we keep mentioning, alongside strategic diversification. Growth through building.
Building new capacity.
Right. Meanwhile, the rest of the industry, particularly the integrated producers, has seen a major wave of consolidation growth through buying. Think of Cleveland-Cliffs' big acquisitions of AK Steel and ArcelorMittal USA a few years back.
Right, they got much bigger quickly.
Exactly. And then more recently, U.S. Steel's agreement to be acquired by Japan's Nippon Steel. This highlights a clear strategic imperative for scale and cost-cutting among these legacy players. It's often driven by the structural challenges of their older, higher-cost assets. They're looking for synergies and efficiencies through M&A.
Two very different paths. Building versus buying. What does this strategic dichotomy mean for you as someone trying to understand the industry and maybe evaluate these companies? It sounds like a fundamental choice point for investors too.
It absolutely is. It means the competitive dynamics are more than just a battle for market share today. They represent a fundamental clash of business models and capital allocation philosophies for the future. The legacy integrated producers, U.S. Steel and Cleveland-Cliffs, face these structural challenges inherent in their older, high fixed cost asset bases. Their primary strategic response has been to pursue large-scale consolidation. It's a strategy aimed at achieving greater scale, maybe rationalizing some overlapping capacity and extracting cost synergies. This is a path to value creation primarily through, you could say, financial engineering and the optimization of existing, often aging assets.
Right, trying to make the old work better together.
Pretty much. Steel Dynamics, on the other hand, born as a nimble mini-mill, just operates with a different corporate DNA. Its growth has been overwhelmingly organic, centered on building new, state-of-the-art facilities from the ground up. This strategy is predicated on the belief that building the industry's lowest cost, most technologically advanced, and most environmentally friendly assets is the superior path to long-term value creation.
So it's a bet on the future versus optimizing the past.
In a way, yes. This presents a clear strategic dichotomy for investors. An investment in STLD is essentially a wager that building new, efficient capacity will ultimately prove more profitable than consolidating older, less efficient capacity. The primary risk for STLD, as we said, lies squarely in project execution. Can they build and ramp up these massive new projects successfully? While a risk for its consolidating peers lies more in successfully integrating disparate corporate cultures and aging asset bases to realize those often elusive M&A synergies. It's a different risk profile.
That's a fascinating way to frame it. Let's zoom in further then on what truly gives Steel Dynamics its edge in this build-not-buy strategy. What are their specific competitive advantages that reinforce this organic growth model and allow them to compete so effectively?
Yeah, they've cultivated a set of distinct, mutually reinforcing advantages over time that allow them to consistently outperform. First, and arguably their most significant and durable advantage, is operational efficiency and cost leadership.
Back to that $160 per ton.
Exactly. The company is relentless in its pursuit of efficiency. Their average cost to produce a ton of steel is approximately $620, substantially below that estimated industry average of $780 per ton. That $160 per ton cost advantage provides a formidable margin cushion. It allows them to remain highly profitable even at steel prices where competitors might be struggling just to break even.
A huge safety net.
Huge! And this cost leadership also enables them to consistently achieve those high utilization rates, 91% in 2023, and reportedly 22% higher labor productivity than competitors. They get more steel per employee hour.
Okay, cost is number one. What else?
Secondly, scrap recycling as a strategic moat is incredibly important. Their ownership of OmniSource provides that powerful strategic advantage by partially insulating them from the volatility of the scrap market, which can be significant.
Right, controlling the input.
Yes. It ensures a reliable supply of high-quality inputs, which is essential for producing the more advanced steel grades customers demand. And it aligns perfectly with circular economy principles, which is increasingly valued. To put it into perspective again, every ton of scrap used in steelmaking avoids the consumption of 1.4 tons of iron ore, 740 kilograms of coal, and prevents the emission of 1.5 tons of carbon dioxide compared to the traditional route.
Wow, huge environmental and cost benefits combined.
Absolutely. It strengthens their entire operational model. Next, technology and modernization. STLD operates a portfolio of modern, state-of-the-art production facilities. Their strategy involves continuous investment in next-generation mills like Sinton. These are designed specifically to produce higher-quality steel grades that can compete directly with products traditionally made only by the integrated producers, thus expanding their addressable market into higher-value segments.
So pushing the boundaries of what EAF can do.
Exactly. They invest about $42 million annually in R&D and hold numerous patents, demonstrating a real commitment to innovation, not just running the mills. Furthermore, their investments in decarbonization technologies, like that planned biocarbon facility we mentioned, proactively lower their already lower carbon footprint and position them favorably for evolving sustainability demands from customers and regulators.
Staying ahead of the curve.
Trying to. And finally, a less tangible but perhaps equally powerful advantage is their management and culture. Underpinning all these operational strengths is a unique corporate culture. It's described as entrepreneurial, decentralized, and driven by a highly levered, performance-based compensation system that extends across the entire organization, not just the top executives.
Interesting. How does that help?
It directly aligns employee interests with shareholder value. It incentivizes innovation, cost control, safety, productivity, right from the ground up. Everyone has skin in the game. The senior leadership team, too, has a long, successful track record of disciplined capital allocation and, crucially, executing these complex organic growth projects. Culture matters.
It really sounds like it.
Yeah.
So it's truly not just a collection of individual strengths then, but a deeply interconnected system at play, creating that virtuous cycle as the analysis describes.
Exactly. That's the perfect way to think about it. These advantages form a virtuous, self-reinforcing cycle. The unique, incentive-driven culture fuels innovation and cost control. This directly translates into those superior operational metrics like the lower cost per ton and the consistently high plant utilization. These best-in-class operating metrics, in turn, generate higher profit margins and stronger, more consistent cash flow through the economic cycle. This robust cash flow then provides the capital necessary to fund the company's disciplined allocation strategy. Investing in modern technology, strategic vertical integration like OmniSource, and those transformational diversification projects like aluminum.
And those investments then strengthen the advantages again.
Precisely. These investments further solidify the company's technological and cost leadership, widening their competitive moat, and crucially, restarting the cycle anew. It's an exceptionally durable system and one that is very, very difficult for competitors to replicate organically. You can't just buy this kind of integrated culture and operational excellence overnight. It makes it a powerful differentiator in the long run.
Okay, that paints a very clear picture of their operational advantages and that really compelling strategic setup. But what do the financial statements actually tell us about STLD's performance and health? Do the numbers truly back up this narrative you've described? Do they walk the walk?
That's always the key question, right? Does
Yeah.
the story match the numbers? And a thorough examination of their historical financial statements does indeed reveal a company with strong, albeit cyclical, growth and a genuinely robust financial position.
Right.
They have consistently demonstrated an ability to generate significant profits and, importantly, cash flow during the cyclical peaks in the steel market. And just as importantly, they maintain solid profitability and financial stability even during the inevitable downturns, which is a powerful testament to the resilience of that business model we've been discussing.
Okay, so let's look at the historical performance analysis.
Right.
The cyclicality is obviously going to be there.
Oh, yeah, it's very evident. For instance, they achieved a record net income of $3.9 billion on record revenue of $22.3 billion back in the very strong market of 2022. A banner year.
Huge numbers.
Huge. Then, in the weaker market environment of 2023, performance naturally moderated, as you'd expect, but it still resulted in a very strong net income of $2.5 billion on $18.8 billion in revenues. Still highly profitable.
Still very strong, yeah.
And more recent results, say from the second quarter of 2025, showed sequential improvement in profitability compared to the prior quarter. That was driven by those expanding metal spreads we talked about, even as the year-over-year comparisons remain challenging due to lower overall steel prices than the year before. This really highlights their operational agility to optimize performance in varying market conditions.
Okay, so if I'm looking at these volatile year-over-year earnings numbers, up big one year, down the next, what's the single most important takeaway from that historical data for understanding STLD's true financial health? Where should I focus?
That's a great question. Don't get solely fixated on those volatile year-over-year earnings fluctuations. Net income bounces around a lot in this industry. The true hallmark of STLD's financial health, and where they truly shine compared to many others, is the consistent and robust generation of operating cash flow.
Cash flow, not just earnings.
Cash flow is king, especially here. In that record earnings year of 2022, cash from operations was a staggering $4.5 billion. But even in the weaker market year of 2023, operating cash flow remained exceptionally strong at $3.5 billion.
Still $3.5 billion in cash,
Right.
even when earnings fell.
Exactly. Notice that the decline in cash flow was far less severe than the decline in net income. This resilience stems directly from their business model, that flexible variable cost structure, and their efficient working capital management. It ensures that even as prices and margins compress, the business continues to convert its earnings into actual cash at a very high rate.
And that cash lets them do what?
Well, this powerful cash generation, even in a relative down year for the cycle, is precisely what allows STLD to simultaneously invest heavily in those big strategic projects like Sinton and aluminum, and return substantial capital to shareholders through dividends and buybacks, all without straining its balance sheet. It indicates that investors should focus less on those volatile year-over-year earnings fluctuations and more on the multi-year average of operating cash flow generation. That's the primary indicator of the company's intrinsic value and its capacity to execute its long-term strategy.
Okay, focus on the cash flow generation over time. What about profitability metrics?
Beyond cash flow, their profitability and returns are also noteworthy. They consistently generate high returns on invested capital, or ROIC. This measures how effectively they use the money invested in the business. Their ROIC figures are often among the best in the entire S&P 500 materials sector, not just among steel companies.
Really? That's impressive.
Yeah. For example, they reported an impressive 3-year after-tax ROIC of 32% for the period ending December 31st, 2023, and a strong 17% for the 3-year period ending more recently in the second quarter of 2025. These figures demonstrate highly effective capital deployment through varying market conditions. It shows they're not just growing, but growing very profitably. In Q2 2025, they reported an adjusted EBITDA margin of 12%, which is considered a solid result in what was a normalizing, maybe slightly weaker market environment.
Okay. And the balance sheet. Are they taking on a lot of debt to fund this growth?
That's another area where they show discipline. Their balance sheet and liquidity reflect a company that prioritizes financial strength and flexibility. Despite those significant organic growth investments, their debt levels are prudently managed. They reported a conservative net leverage ratio, that's debt relative to earnings, of 1.6x adjusted EBITDA in Q2 2025, and a modest total debt-to-equity ratio of approximately 0.47x.
They're not overly leveraged.
Not at all. This indicates a healthy balance between debt and equity financing. They also maintain substantial liquidity cash and available credit, reporting $1.9 billion at the end of Q2 2025. This provides ample flexibility for ongoing operations, capital expenditures, and those shareholder returns we discussed. In fact, in that same quarter, Q2 2025, they actually used some of their strong cash flow to repay $400 million of senior notes early, further demonstrating their commitment to maintaining balance sheet strength, even while investing heavily.
Okay, strong financial position.
Yeah.
And looking at the different parts of the business, the segment performance analysis, how do they contribute?
Right. The overall results are a composite of how the distinct segments perform. The steel operations segment, being the largest, is naturally the primary driver of earnings and is highly sensitive to that critical metal spread we keep mentioning. Right. The steel fabrication segment, however, acts as that powerful countercyclical buffer. Because its primary input is steel, its profit margins often expand when steel prices are falling, so it provides a natural hedge to the steel operations segment when times get tough there. This fabrication business actually generated record operating income in 2022 and its second best annual performance in 2023, clearly demonstrating its value in a volatile price environment.
So it smooths things out.
It does, and the metals recycling segment, OmniSource, its earnings are, as you'd expect, closely tied to scrap prices and the volumes they process. Its performance was more challenged in 2023 as falling scrap prices compressed their margins. So this diverse mix, with different parts responding differently to market conditions, helps them weather economic shifts more effectively than a pure-play steelmaker might.
That makes a lot of sense. That financial strength seems to be funding some really ambitious plans for the future, as we've alluded to. Let's talk more explicitly about their growth trajectory and strategic initiatives. This isn't just about incremental expansion, is it? It feels like they're trying to transform the very nature of their business in some ways.
Indeed. This is very much the current focus of the company and where management believes a lot of the future value creation is going to come from. The first major initiative is the Sinton, Texas flat roll mill.
Right, the big new steel mill.
Exactly. This was a $1.9 billion greenfield project built from scratch. It's a next-generation EAF mill with a massive 3.0 million tons of annual capacity. It's strategically located down south to serve the high-demand U.S. Southwest and Mexico markets. And critically, it's designed with advanced capabilities for producing those high-value added flat-rolled steels, particularly for the automotive and energy sectors.
How's it performing?
Well, it did encounter a temporary 65-day oxygen supply limitation in Q2 2025, which reduced its output by an estimated 55,000 tons. Startup hiccups happen. But importantly, even with that issue, the mill still achieved pre-tax break-even during the quarter. That's actually a significant accomplishment for a massive new mill still in its ramp-up phase.
Breaking even already is pretty good.
It is, and management is highly optimistic. They're expecting a steep acceleration of profitability for the remainder of 2025 and into 2026 as these initial issues resolve and the mill ramps up towards its full potential.
Okay, Sinton is key. Then there's the really big one, the transformational diversification into aluminum.
Yeah, the aluminum mill. This is arguably their most ambitious initiative ever. It's a $2.7 billion investment in a 650,000-ton state-of-the-art recycled aluminum flat-rolled mill located in Columbus, Mississippi.
$2.7 billion. Bigger than Sinton.
Bigger investment, yes. And this main mill will be supported by 2 satellite recycled aluminum slab centers nearby. These will process aluminum scrap and supply the main facility with purified molten aluminum or solid slabs.
And the logic behind this huge move.
The strategic rationale is clear, even if bold. It leverages STLD's deep expertise in scrap sourcing through OmniSource. They already handle lots of aluminum scrap, and their proven ability to operate efficient, recycling-based metal production facilities. They know this model.
Applying the steel playbook to aluminum.
Pretty much. This venture also diversifies their end market exposure significantly. It provides entry into the large and relatively stable, sustainable beverage can market, think so, and beer cans. That's a huge market they were in before, while also serving their existing automotive and industrial customers who consume aluminum as well as steel.
So, new markets and cross-selling, what are the financial expectations?
Management projects, it will add somewhere between $650 million and $700 million in annual through-cycle EBITDA once it's fully operational. That's a massive chunk of earnings.
Huge potential impact. And they've started production.
Yes, the first commercial coils shipped in June 2025, which was a major milestone. They're targeting 40-50% utilization by the end of 2025 and aiming for 75% by the end of 2026. So the ramp-up is underway now. It's a truly significant new growth platform for the company.
Okay. Beyond these enormous greenfield projects, what else are they doing to grow?
They're also focused on the expansion of value-added products within their existing steel footprint. They're currently adding 4 new flat-roll steel finishing lines across their network, 2 paint lines, and 2 galvanizing lines. Together, these will increase their annual capacity for these premium, higher-margin products by another 1.1 million tons.
So moving up the value chain.
Exactly. This is a direct response to strong customer demand for coated products, and it further enhances their product mix for improved profitability. It's not just about tons, it's about the value of those tons.
Right. And you mentioned sustainability as a driver.
Yes, they actively view decarbonization as a growth driver, not just a cost or a compliance issue. STLD sees sustainability as a competitive advantage. They're investing, for example, in a proprietary biocarbon production facility. This will produce a renewable, lower carbon substitute for the fossil fuel-based carbon, usually coal, that's sometimes used as an input in the EAF process.
Interesting. Using biomass instead of coal.
Essentially, yes,
Yeah.
especially processed biomass. And this innovator project is expected to reduce their Scope 1 steelmaking emissions, the direct emissions from their furnaces, by as much as 35%.
Another big step.
Yeah. Management strongly believes the growing demand from customers for lower carbon, domestically produced steel and aluminum will be a significant competitive advantage moving forward. It positions STLD as a supplier of choice for sustainability-focused customers, particularly large automotive OEMs and consumer brands who are under increasing pressure to decarbonize their own supply chains. They want green steel and green aluminum.
So this isn't just growth for growth's sake then, is it? It feels like a very deliberate, targeted expansion into new areas, building on their strengths rather than just getting bigger for the sake of getting bigger.
No, you've hit it exactly. It's a direct replication and scaling of their core EAF mini-mill playbook into new products like aluminum and new geographies like the Southwest with Sinton. The aluminum venture, while it looks like a major diversification into a new metal, is really a calculated application of their proven formula for disrupting incumbents' potentially higher-cost industries using recycled materials and efficient technology.
Disrupting aluminum like they disrupted steel decades ago.
That seems to be the ambition. The North American aluminum flat-rolled market, much like the steel market was decades past when mini-mills emerged, is characterized by older legacy producers and now has this growing demand for recycled low-carbon products. STLD's strategy is to enter this market with a brand new, technologically superior, scrap-fed mini-mill specifically designed for aluminum. They will leverage their existing OmniSource platform for the scrap supply, and importantly, they'll target many of the same automotive and industrial customers they already serve with steel, offering them a dual material solution.
Makes sense. But it's still risky.
It's absolutely a high-risk, high-reward strategy. The risk is that the technical challenges of producing high-quality, flat-rolled aluminum from scrap, or the market dynamics, prove to be greater or different than anticipated. Aluminum is not steel, but the reward is the potential to create a second powerful growth engine with a business model that mirrors the one that has been so incredibly successful for them in steel. If they pull it off, it could lead to a significant re-rating of the company's long-term growth profile and its valuation by the market. It's a bold but strategically sound move based on their core capabilities.
Okay, so with all that impressive cash generation we talked about and these really ambitious growth plans, how does Steel Dynamics decide where to put its money? What's their capital allocation philosophy? It sounds like they have a lot of options, maybe more cash than they know what to do with sometimes.
They absolutely do generate a lot of cash, and they operate with a very clear, disciplined, and balanced framework that's designed explicitly to maximize long-term per-share value for their investors. The company's business model is just a prodigious generator of cash, Mary. Our sources note $12.8 billion in cash flow from operations over just the last 5 years.
$12.8 billion.
Yeah. And management follows a very clear hierarchy for the deployment of this capital. It's not random.
What's the hierarchy? What comes first?
Their top priority is always to reinvest in the business. Specifically, they aim to fund those high-return organic growth projects we've been discussing, and also just to maintain their state-of-the-art asset base through regular maintenance CapEx. This commitment is clearly evidenced by the massive capital expenditures allocated recently to the Sinton steel mill, the new aluminum mill, and those value-added finishing lines. They believe firmly in feeding the engine that drives their future growth and maintains their competitive edge. First use of cash, build and maintain the business.
Okay, reinvestment first. What's next?
After fully funding those strategic growth initiatives and maintenance needs, they are committed to returning capital to shareholders. And they do this through a dual approach. both dividends and share repurchases.
Tell us about the dividends.
For dividends, they have an established policy of paying a sustainable and consistently growing dividend right through the entirety of the steel cycle, good times and bad. They have an impressive track record to support this, having increased their dividend for 10 consecutive years now.
A decade of increases.
Yeah. The current yield is approximately 1.5%, which might seem modest compared to some other sectors, but critically, it's very well covered by the company's cash flow, even at cyclical lows. This indicates high sustainability. They're not stretching to pay it.
Okay, dividends are steady and growing. What about buybacks?
Beyond dividends, share repurchases are a really key tool for value creation in their strategy. They've been an aggressive and opportunistic repurchaser of their own stock. They view buybacks as a flexible and often tax-efficient method for returning capital when they feel their shares are undervalued or when they simply have excess cash after funding growth. This strategy has been a major contributor to their per-share earnings growth over time simply by systematically reducing the number of shares outstanding.
How much have they bought back?
Over the last 5 years, they've dedicated approximately $6.0 billion to buybacks.
$6 billion.
Yeah, including $200 million in Q2 2025 alone, which represented about 1.1% of their outstanding shares retired in just that one quarter. That's a serious commitment to returning cash via buybacks.
Definitely. And the last piece of the framework.
And finally, a core tenet of their financial philosophy is maintaining financial flexibility. They prioritize a strong balance sheet and a conservative leverage profile, as we discussed earlier. Management is committed to funding their growth primarily through internally generated cash flow, ensuring that debt levels remain manageable and don't become a burden.
Right, like paying down that debt recently.
Exactly. That discipline was demonstrated in the second quarter of 2025 when the company used its cash flow to repay $400 million of its senior notes. This approach provides them with significant strategic and financial flexibility. It allows them to navigate economic downturns with resilience and also to seize unexpected growth opportunities if they arise without having to worry about their debt load.
Okay, that capital allocation strategy sounds very deliberate and well thought out, almost textbook. What does it tell us about management's overall approach to the business? What's the underlying philosophy?
I think it tells us that this is a management team that is simultaneously aggressive in its pursuit of high return growth and profoundly conservative in its stewardship of the balance sheet. It's a careful balance.
Aggressive and conservative at the same time.
Yeah. Their prodigious cash flow first funds their ambitious growth projects like Sinton and the aluminum mill, that's the aggressive part. Then the commitment to a steadily growing dividend provides that baseline return to shareholders, offering a degree of predictability. And then the substantial share buyback program acts as a flexible release valve for the significant excess cash flow that remains after dividends and growth capex are covered.
A release valve. Interesting.
Yeah, instead of allowing this cash to just accumulate inefficiently on the balance sheet, earning very little, or perhaps worse, pursuing potentially value-destructive large-scale mergers and acquisitions, which notably have been a minimal spend for STLD historically.
Right. They build, not buy.
Exactly. Management has chosen to return that excess cash to shareholders primarily by systematically reducing the share count through buybacks. This disciplined, multi-pronged approach is indicative of a sophisticated financial management team that is focused squarely on maximizing per-share value, not just growth for growth's sake or empire building. And that large, active buyback authorization also serves as a powerful signal of management's confidence in the company's intrinsic value and future prospects.
Okay, that makes sense. So with all this cash generation, this growth, this disciplined allocation, how do we actually value a company like this, especially given the inherent cyclicality of the steel industry and all this new growth coming online from Sinton and aluminum? It feels like trying to hit a moving target.
It is challenging. Valuing a cyclical company like STLD, particularly at this major inflection point with the aluminum diversification, requires nuance and definitely a multifaceted approach. You really have to look beyond simple point-in-time metrics.
So what do we look at?
Well, we look at its current valuation multiples, things like PE ratio or EBITDA, compared to its own historical ranges and compared to its closest peers. And perhaps most importantly, we try to assess its normalized earnings power through a full economic cycle, smoothing out the peaks and troughs.
Okay, let's start with relative valuation analysis. How does STLD trade compared to its competitors?
Right now, STLD's valuation sits in a pretty logical position relative to its primary competitors. The company currently trades at a trailing 12-month or TTM, price to earnings, or PE, ratio of approximately 17x.
17 times earnings. Okay.
Now, this represents a notable discount to its closest and largest EAF peer, Nucor, which trades at a higher PE of around 25x. However, that 17x is a significant premium compared to the more distressed and volatile valuations of the integrated producers. Cleveland-Cliffs currently has negative reported earnings, so no meaningful PE, and U.S. Steel is trading at a much higher 128x PE, but that's due to very low recent earnings, making the ratio look odd.
So cheaper than Nucor, more expensive than the integrateds.
Generally, yes, on a PE basis. If you look at another common metric, enterprise value to EBITDA, or EBITDA, STLD, and Nucor are valued more similarly, both trading at around 11x currently.
Okay. But here's an interesting point you flagged earlier when we look at historical comparison. STLD's current TTM PE ratio, around 17x, is substantially higher than its own 5-year average PE ratio, which was down around 7.3x. That's a big jump, more than double its historical average multiple.
Here's a very significant jump.
So what does that suggest? Is the market suddenly seeing something fundamentally different in steel dynamics than it did over the past 5 years? Why the re-rating?
It absolutely does suggest that. It strongly implies that the market is no longer valuing STLD solely as a pure play, deeply cyclical steel company whose value just goes up and down with steel prices. Instead, the market appears to be pricing in a significant amount of future growth and potentially higher, more stable earnings streams coming from its new strategic initiatives, namely Sinton, and especially the aluminum diversification.
So the market's giving them credit for the future potential.
It seems so. The market appears to be looking past any current cyclical softness in the steel market and valuing the company more on its normalized future earnings potential, a potential that explicitly includes the full contribution expected from these new assets once they're fully ramped up. This indicates a potential re-rating of the company's long-term prospects, and maybe a view that it's becoming a less cyclical, more diversified industrial company.
Okay, so how do we estimate that future potential, that normalized earnings power?
It's tricky, but one way is to look back to smooth out the cycles. Based on its financial performance from 2019 to 2023, a period which included both strong peaks and weaker troughs in the steel market, STLD's 5-year average adjusted EBITDA was approximately $3.7 billion per year. That gives us a historical baseline. Now, looking forward, you have to adjust that baseline upward to account for the expected full run rate contribution from the Sinton Mill and the new aluminum facility. Once those are fully operational and contributing as projected, their future normalized earnings power could realistically be in the range of $4.5 billion to perhaps $5.0 billion per year, although that's obviously subject to future market conditions and critically successful execution of those ramps.
A potentially significant uplift in baseline earnings. And what about that sum of the parts approach you mentioned? How does that help?
Given the company's recent transformational diversification into aluminum, a sum of the parts, or SOTP, analysis becomes increasingly relevant. This approach involves trying to value each of the company's distinct business segments, steel operations, recycling, fabrication, and now aluminum separately, as if they were standalone companies, using appropriate multiples for each type of business. Then you sum those individual values to arrive at a total enterprise value for STLD.
Why is that useful now?
Because the new aluminum segment alone is projected to add $700 million in annual through-cycle EBITDA. That's a huge new piece. An SOTP analysis helps determine if the current overall market valuation fully reflects the potential value of this significant new earnings stream, especially considering you might apply a different valuation multiple to an aluminum business than a steel business, and you need to factor in an appropriate discount for the execution risk and the time it will take to reach full potential. It helps see if the market is giving full credit yet.
Okay, so boiling down for our listener, what's the central valuation debate here that we should be considering when looking at STLD stock?
The central debate for investors right now, given that higher than historical multiple, is whether this anticipated future growth and margin expansion from Sinton and aluminum is already fully priced into the stock at that current 17x PE ratio, or if there's further upside potential if management executes successfully on these projects and the market fully re-rates STLD as a more diversified, higher growth, and perhaps less cyclical industrial enterprise over time. It's a classic question. How much of the good news is already baked into the price?
Right. Future potential versus current market expectation. Okay. Every investment has its risks, and steel is certainly no exception. Let's look squarely at the key risks for STLD and, importantly, how they attempt to mitigate them given this unique setup you've described.
Absolutely. Risk management is crucial here. The primary and most unavoidable risk for STLD, like any steel company, is cyclicality and economic sensitivity. Demand for steel is highly correlated with the health of the broader economy. A significant economic downturn leading to a contraction in construction, manufacturing, and automotive activity that would inevitably result in lower steel volumes, falling prices, and severe margin compression. It's just the nature of the beast.
Can't avoid the macro cycle entirely. How do they mitigate it?
While STLD has significant mitigating factors built into its model, its low-cost, highly variable EAF structure allows it to quickly adjust production levels and manage costs far more effectively during downturns than the integrated producers with their high fixed costs. They can throttle back more easily.
Yep.
Additionally, that countercyclical nature of its steel fabrication business provides a partial earnings hedge. Remember, its margins often expand when steel prices are falling. This helps the company remain profitable and strongly cash flow positive even during significant industry downturns, smoothing out the bumps somewhat.
Okay, what's the next major risk?
A second key risk is raw material and input cost volatility. Their profitability is highly sensitive to fluctuations in the prices of key inputs like scrap steel, electricity, and natural gas. A sharp increase in these costs that cannot be fully passed on to customers could compress that crucial metal spread and significantly reduce earnings.
How do they handle that? OmniSource helps with scrap, right?
Exactly. Their mitigation here lies partly and significantly in their vertical integration through OmniSource. This provides a substantial partial hedge against scrap price volatility by securing a large portion of its supply internally, often at a cost advantage, and with more reliable quality control. They also employ strategies like entering into long-term energy contracts and have a relentless focus within their operations on improving energy efficiency to manage their exposure to those volatile energy markets.
Okay. What about competition and imports?
Yeah.
Still a risk.
Always. The U.S. steel market faces persistent competitive pressure from lower-priced imports, particularly from regions with structural overcapacity like China or Southeast Asia. A sudden surge in unfairly traded imports could definitely undermine domestic pricing discipline and erode market share for all domestic producers, including STLD.
And their defense.
Their mitigation includes leveraging government trade policies, such as tariffs and anti-dumping duties, which do provide a degree of protection for the domestic industry, although their effectiveness can vary. More fundamentally, STLD's competitive advantages lie in its ability to provide high-quality, value-added products with shorter lead times and more reliable domestic delivery compared to imports. These are key advantages, especially when supply chains are uncertain. Customers often pay a premium for that reliability and quality consistency from a domestic source.
Okay, now this next one seems particularly relevant right now. Project execution risk.
Yes, this has become a major near-term risk factor for the company, perhaps the biggest one investors are focused on. STLD is currently executing the largest capital investment program in its entire history, simultaneously ramping up Sinton and building the massive aluminum complex.
Huge undertaking.
Huge. The ramp-up of the Sinton mill has already encountered some operational hurdles, as we mentioned with the oxygen supply. And the $2.7 billion aluminum mill is a massive, complex greenfield project in a completely new industry for the company. Any significant delays, cost overruns, or failure to achieve the projected financial returns from these projects could materially impact the company's financial performance and definitely investor sentiment.
What's their mitigation strategy here? Just good management?
Primarily, yes. The company points to its management team, which does have a long and demonstrably successful track record of executing large, complex capital projects, historically often on time and on budget. That's their main defense. We know how to do this. Furthermore, the somewhat staggered timeline of these projects getting Sinton mostly up before aluminum fully ramps also allows the company to manage its cash flow and capital commitments more effectively and potentially apply learnings from one project to the next.
Okay. What about environmental regulations? Is that a growing risk?
It's a consideration for the entire industry. As a relatively carbon-intensive sector, steel manufacturing faces increasing scrutiny from regulators and society regarding emissions. The potential introduction of stricter regulations, maybe even a carbon tax or pricing scheme in the future, could increase operating costs for the entire industry.
But you said STLD might have an advantage here.
Exactly. This risk area is actually a source of significant relative advantage for STLD. Its EAF production process is already substantially less carbon intensive than the traditional blast furnace technology used by its integrated competitors. As a result, any future carbon tax or pricing scheme would likely impose a much smaller cost burden on STLD than on its integrated competitors, potentially further widening its existing cost advantage.
So regulation could actually help them competitively.
It could. And they are proactively strengthening this advantage through investments like their biocarbon facility, positioning them even more favorably for a potentially more carbon-constrained future. They're leaning into it.
Okay. Lastly, just the inherent dangers of the business. Operational and safety hazards.
Yes, that's always present. Steel manufacturing is an inherently dangerous industrial activity. There are significant risks of serious accidents, including burns from molten metal, equipment malfunctions, crane incidents, explosions. It requires constant vigilance.
And their approach.
STLD's mitigation involves placing a paramount emphasis on its safety culture. It's reportedly their top priority, and providing extensive ongoing training for its employees. This focus has yielded tangible results, with the company achieving its best ever safety year in 2023, recording its lowest ever recordable incident rate across its operations. For them, safety isn't just a compliance issue, it's deeply ingrained in their operational excellence philosophy and linked to that performance-based culture.
So listening to all these risks, it sounds like the nature of the risk profile for STLD has actually shifted significantly in recent years. It's moved beyond just worrying about macroeconomic cycles, hasn't it?
Yes, I think that's a crucial insight and a great summary. While the traditional macro-driven cyclical risks certainly remain, they're unavoidable in the steel industry. The primary focus for investors looking at STLD in the near to medium term should absolutely be on the idiosyncratic, company-specific execution risk associated with its major growth projects.
Less about the cycle, more about their execution.
Exactly. For decades, the key variable for predicting any steel company's performance was largely understanding the economic cycle. STLD has, by and large, proven its ability to navigate the cyclicality more effectively than its peers due to its superior, more flexible business model. They manage the cycle well.
But now,
the company has embarked on its most ambitious growth phase ever, committing nearly $5 billion to the Sinton and aluminum projects combined. The success or failure of these two massive projects will likely have a far greater impact on STLD's per-share value over the next 3 to 5 years than a moderate economic fluctuation probably would.
that puts it in perspective.
Yeah. To illustrate, that aluminum project alone is projected to add $650–700 million in annual EBITDA. That figure is equivalent to approximately 20% of the company's entire adjusted EBITDA generated in 2023, just from one project. Therefore, the investment case for STLD has really evolved. It's shifted from primarily predicting the steel cycle to now assessing management's project management capabilities and their ability to successfully integrate and operate these transformative new assets. The company's future is now, more than ever before, truly in its own hands.
Wow. Okay, so what does this all mean for you, our listener? We've covered a tremendous amount of ground here, right? From the nuts and bolts of EAF technology and circular models to these ambitious multi-billion-dollar projects in steel and aluminum. Let's try to crystallize things by tackling some of the biggest questions someone trying to understand this company might have, drawing out those core insights we've just discussed. Sound good?
Let's do it. Recap time.
Okay, first big question. How sustainable is STLD's cost advantage versus those integrated steel producers? Is that $160 per ton gap likely to stick?
The analysis suggests it's highly sustainable and rooted in fundamental technological and structural differences, not just temporary factors. STLD's exclusive use of EAF technology provides that lower capital cost base, a more flexible and variable operating cost structure, and higher energy efficiency compared to the capital-intensive, high fixed-cost blast furnace model.
And the scrap integration helps too.
Massively. That's fortified by their vertical integration into scrap recycling via OmniSource, which provides a more stable and often cost-effective raw material supply chain compared to buying ore and coal. These are durable, structural advantages, not temporary cyclical ones that can be easily competed away.
Okay, advantage looks durable. Next, what is their normalized earnings power through a full steel cycle? You touched on this, but what's a reasonable range to think about?
Yeah, pinpointing an exact figure is always challenging for a cyclical company, but we can estimate. Looking back at the 5-year period from 2019 to 2023, which included both strong peaks like 2022 and weaker markets like 2020, STLD generated an average adjusted EBITDA of roughly $3.7 billion per year. That's a decent historical baseline reflecting a mix of conditions.
Okay, $3.7 billion historical average. And going forward.
Looking forward, this baseline needs to be adjusted significantly upward to account for the expected full run rate contribution from the Sinton Mill and the new aluminum facility. Once those are fully operational and contributing as management projects, they are expected to add over $1.1 billion combined in annual through-cycle EBITDA. This suggests a future normalized earnings power potentially in the range of $4.5 billion to maybe $5.0 billion per year, although that's obviously subject to market conditions and crucially successful execution of those project ramps.
A big step up in potential baseline earnings. Okay, next question. How effectively can they maintain market share amid all this industry consolidation we're seeing with their competitors buying each other?
STLD appears well positioned to not only maintain but potentially grow its market share, even with consolidation happening elsewhere. While competitors like Cleveland-Cliffs have pursued growth mainly through consolidating older assets, STLD's strategy is fundamentally different. They grow by building new, technologically superior, and lower-cost capacity.
The build versus buy again.
Exactly. As the industry's lowest cost producer in many product lines, STLD can compete effectively on price in almost any market environment, which is a powerful tool for taking share, especially from higher cost producers. Furthermore, its focus on value-added products and its clear leadership in low-carbon steel production make it an increasingly attractive partner for customers who are consolidating their own supply chains around the most reliable, cost-effective, and sustainable suppliers. They could actually benefit as customers rationalize suppliers.
Interesting angle. Okay, what about their finances? What is the optimal capital structure for managing cyclical volatility? Do they have it right?
Their current capital structure appears to be pretty close to optimal for managing the inherent cyclicality of their business. This involves maintaining that conservative leverage profile we discussed, net leverage around 1.6x EBITDA, and a strong liquidity position, currently $1.9 billion.
Why is that optimal?
Because that strong balance sheet provides the resilience to withstand downturns without financial distress, unlike more heavily indebted competitors might face. It also gives them the flexibility to continue investing for the long term, even when markets are weak. And the combination of a modest, steadily growing dividend with that large, flexible share repurchase program allows the company to adjust its total capital returns to shareholders based on the cash flow generated in any given year. It's a stable base with a flexible top-up.
Makes sense. Now, shifting gears to a major end market, how will the transition to electric vehicles affect their automotive steel demand? Is it a threat or an opportunity?
The consensus from the analysis is that it's expected to be a net positive for STLD. As we discussed, EVs are generally heavier than their internal combustion engine counterparts due to the batteries. This increases the demand for those advanced high-strength steels, or AHSS, that can provide the necessary structural integrity at a lower weight to help offset the battery weight and improve range.
And STLD makes those steels.
Exactly. STLD's modern mills, particularly the new Sinton facility, are specifically designed to produce these advanced high-value steel grades that EVs need. Furthermore, as automotive OEMs intensify their focus on reducing the total carbon footprint of their vehicles, not just tailpipe emissions, but the emissions embedded in manufacturing.
The Scope 3 emissions.
Precisely. STLD's low-carbon EAF steel becomes a much more attractive option compared to steel made from traditional blast furnaces, giving them a significant competitive edge in supplying this evolving market.
Okay, EVs look like a net positive. What about infrastructure? What are the long-term implications of all this infrastructure investment on steel demand?
The long-term implications are significant and overwhelmingly positive for domestic steel demand. The Infrastructure Investment and Jobs Act provides a multi-year, federally funded catalyst for a vast array of steel-intensive projects across the U.S., bridges, roads, water pipes, grid upgrades.
A long runway of demand.
Exactly. This is expected to create a sustained period of elevated demand for products like structural steel, rebar, plate, and flat-rolled steel used in construction, providing a strong baseload of demand for the domestic steel industry for much of the next decade. This is not a fleeting trend, but a foundational multi-year demand driver, especially with those Buy American provisions attached.
Great. Final question. How exposed is the company to potential carbon pricing or stricter environmental regulations? We touched on this, but bottom line.
Relative to its domestic and global peers, STLD is actually one of the least exposed companies to carbon-related regulatory risk. In fact, as we discussed, such regulations could ultimately represent a significant competitive advantage for them.
Because their process is already cleaner.
Exactly. Its EAF process already generates just a fraction of the carbon emissions associated with traditional blast furnaces. As a result, any future carbon tax or pricing scheme would impose a much smaller cost burden on STLD than on its integrated competitors, potentially further widening its existing cost advantage and strengthening its market position as the preferred supplier for carbon-conscious customers. They're comparatively well-positioned for a lower carbon future. Hashtag tag outro.
So you've just completed a really deep dive into steel dynamics. What started as perhaps an analysis of a seemingly traditional, maybe even old economy industry has revealed, I think, a story of incredible innovation, real strategic foresight,
Definitely.
and a fascinating example of how technology like EAF and a unique business model that circular integration can create significant, durable competitive advantages. It's become clear listening to this analysis that the future of steel, at least here in the U.S., is actively being forged by companies like STLD.
Absolutely. And this deep dive really invites us, I think, to consider how industries we might casually think of as old or mature are constantly reinventing themselves. They're being driven by technological advancements like EAF decades ago and maybe AI or new material science today, and also by these evolving demands for things like sustainability. It makes me wonder, what other seemingly traditional industries out there are quietly undergoing a similar transformation right now, driven by a focus on efficiency, relentless innovation, and a long-term strategic vision, leading us to perhaps redefine what value and growth truly mean, maybe in some unexpected places. Something to think about.
A great provocative thought to end on. Thank you for joining us on this deep dive. Until next time, keep learning and keep digging deeper.